Most financial advice is loud, it is complicated, it is packed with products, platforms, strategies, and steps that somehow require you to already have money before any of it works. Minimalist money is the opposite of that. It is the version of personal finance that your most financially stable friend lives by, quietly, without making a speech about it. She is not watching the market every hour. She is not on five different budgeting apps. She does not talk about money the way anxious people talk about money. She just has it, and it keeps growing. I am Maxine. I am Rich Auntie Knows. And today, I am giving you the 13 laws that financially stable people operate by. Laws that are simple enough to start today, powerful enough to change your entire financial life, and built to bridge you from just surviving to actually building wealth. These are not tips, they are laws, and laws work whether you believe in them or not. Law number one: spend less than you earn every single month, no exceptions. I know you have heard this before, but I need you to hear it differently today. Not as advice, but as the foundation every other law is built on. If this law breaks, every other law stops working. There is no investing strategy, no savings hack, no financial tool in existence that survives you consistently spending more than you bring in. The minimalist version of this law is simple: know your number. Your number is your monthly take home minus your fixed expenses: rent, utilities, insurance, debt minimums. Whatever's left is what you have to work with, not what you hope is left, not what you think is left, what the actual number says. Know your number, live inside it. Everything else builds on this. Law number two: pay yourself first, before the bills, before the groceries, before anything else. The standard approach to saving is this: you pay your bills, cover your expenses, buy what you need, and save whatever is left over at the end of the month. The problem with that approach is that there is almost never anything left over. Life expands to fill the money available. Minimalist money flips this entirely. The moment your paycheck lands, a fixed amount moves automatically to savings and investments before you touch a single dollar for anything else. You pay yourself first, then you live on what remains. This is not a mindset shift, it is an automation. Set it up once, and the decision is made for you every month, permanently. Even if the amount is $25, even if it is 10, automate the transfer, remove the decision, pay yourself first. Law number three: own one savings account you do not look at. Not your checking account, not the savings account linked to your debit card that you can drain in 30 seconds. A separate account, ideally at a completely different bank, that exists for one purpose only: emergencies. And the rule is that you do not look at it unless something has genuinely gone wrong. The high yield savings accounts available right now are paying between 4% and 5% annually. That means your emergency fund is not just sitting there, it is growing. A $3,000 emergency fund in a high yield savings account earning 4.5% generates $135 a year in interest without you doing a single thing. One account, one purpose. Do not touch it. Let it grow quietly in the background. Law number four: the only debt worth carrying is debt that costs less than the market returns. Not all debt is the enemy. That is one of the most important things minimalist money teaches. A mortgage at 6% on a property that appreciates at 4% annually is manageable math. A student loan at 5% while your index fund grows at 10% means you are net positive by staying invested rather than rushing to pay it off. But a credit card at 24% interest is wealth destruction in real time. There is no investment on earth that reliably returns 24%. Every month that balance carries, the interest is quietly dismantling everything you are trying to build on the other side. The law is simple: debt above 10%, attack it. Debt below 7%, manage it steadily while you invest the difference. Debt between 7% and 10%, use your judgment and your cash flow, but never carry high interest debt and invest at the same time. You are not building wealth. You are filling a bucket with a hole in it. Law number five: One index fund is enough. The financial industry profits from complexity. It wants you buying multiple funds, switching between strategies, paying advisors to manage a portfolio that changes with the headlines. Because a busy, confused investor is a paying investor. Here's what the data actually shows. Single low-cost S&P 500 index fund has outperformed the majority of professionally managed funds over every 10-year period ever studied. One fund bought consistently, left alone. Vagi TSAX, Fidelity's FZROX, Schwab's SWTSX, any of them. Pick one, buy it every month. Stop there. The complexity is not making you richer, it is making someone else richer. One fund, consistent contributions, leave it alone. That is the whole strategy. Law number 6, never make a financial decision when you are emotional. The market drops 15% and your stomach drops with it. Every instinct says sell, get out, protect what is left. And that instinct is exactly wrong. And the financial industry knows it and counts on it. Volatility is not loss. A drop in your account balance is only a real loss if you sell at the bottom. If you stay invested, the drop is temporary. The market has recovered from every single crash in its history: the 2008 financial crisis, the 2020 pandemic drop, every recession before and between them. It has always come back. And every time it drops, the shares you buy at the lower price are worth more when it recovers. The minimalist law here is this: make your financial decisions once on a calm day with clear numbers in front of you. Set your automatic contributions. Set your asset allocation. Write down your plan. And then do not touch it when emotions arrive, because emotions will arrive, and the plan is what you return to. Law number 7, your lifestyle should inflate slower than your income. You get a raise, you move to a nicer apartment. You get another raise, you upgrade the car, you get a bonus, you take the expensive trip. This is lifestyle inflation. And it is the reason people earning six figures still feel broke. The minimalist law is not that you cannot enjoy your income growing. It is that your savings and investment rate should grow at the same pace as your lifestyle does. If your income goes up by $500 a month, at least 200 of that goes to your investment account before the lifestyle upgrade happens. Non-negotiable. Because the goal is not to look wealthy, the goal is to be wealthy. And those two things require completely different financial behaviors. Looking wealthy spends the raise, being wealthy invests it. Every raise is an investing opportunity disguised as extra income. Split it before you spend it. Law number 8, automate everything that does not require your judgment. The most financially stable people are not more disciplined than everyone else. They have removed discipline from the equation entirely. Their savings transfer on the first of the month automatically. Their investment contribution hits their Roth IRA automatically. Their utility bills are on auto pay. Their debt minimum payments never require a decision. Every financial action that requires you to manually decide to do it is a financial action that is one bad week away from not happening. Automate the non negotiables. Then your willpower is free for the decisions that actually require it. Automation is not laziness, it is the most disciplined financial decision you can make. Law number 9, your net worth matters more than your income. Income is what comes in every month, net worth is what stays. And the two numbers are almost completely unrelated for most people. There are people earning 40,000 with higher net worths than people earning 120,000 because one person built assets and the other spent the gap. Your net worth is everything you own minus everything you owe. Your investment accounts, your savings, any property you hold, minus your debts, your loans, your credit card balances. That number is your real financial picture, not your salary, not your title, not what your lifestyle looks like from the outside. Start tracking it. Every quarter, write down your net worth, watch it grow, because a rising net worth, even slowly, even from a small starting point, is compounding, doing exactly what it is supposed to do. Law number 10, buy assets, not aesthetics. Every dollar you spend falls into one of two categories. It either buys you something that goes down in value, a car, a wardrobe, a dinner, a gadget, or it buys you something that goes up in value or generates income, an index fund share, a property, a dividend paying stock, a skill that increases your earning power. Minimalist money does not say never spend on aesthetics. It says know which category every significant purchase falls into and make sure the asset column is growing faster than the aesthetics column. Because aesthetics give you a moment, assets give you options. And options are what financial freedom actually feels like. The next time you're about to make a large discretionary purchase, ask one question: is this an asset or an aesthetic? If it is an aesthetic, you are allowed to buy it, but an equal amount goes to your investment account first. That is the law. Assets buy your future, aesthetics buy your present. Invest in both, but never sacrifice the first for more of the second. Law number 11, review your finances once a month, not once a day. Checking your investment account every day is one of the most expensive habits in personal finance, not because anything changes, because your emotional response to what you see changes your behavior. You see a down day and you feel anxious. You feel anxious and you make reactive decisions. Reactive decisions cost money. The minimalist law is a monthly financial review, 1 hour, once a month. You look at your net worth, your savings rate, your investment contributions, your debt balances. You make any adjustments needed, and then you close the laptop and live your life for the next 30 days. Your index fund does not need your supervision, it needs your consistency. Check it monthly, contribute to it consistently, leave it alone in between. That cadence is what stable investors operate on. Manage your money monthly, not daily. Daily watching creates anxiety. Monthly reviewing creates wealth. Law number 12, the tax advantaged account is always the first account you fill, before a regular brokerage account, before a savings account beyond your emergency fund. The Roth IRA gets funded first. The 401k up to the employer match gets funded first, because inside these accounts, your compounding is either tax free or tax deferred. And that difference over decades is enormous. If your employer matches your 401k contributions and you are not contributing enough to capture that match, you are leaving free money on the table every single paycheck. A 3% match on a $40,000 salary is $1,200 a year your employer is trying to give you. Uncaptured, that $1,200 compounding at 10% over 30 years is $209,000 gone because the account was not set up. Law number 13, financial stability is a decision you make before the money arrives, not after. Here's the law that ties everything else together. The biggest lie about financial stability is that it comes from having more money, that if you could just earn a little more, get one more raise, land one better opportunity, then you could finally get ahead. But financial stability is not an income level, it is a set of decisions. And those decisions have to be made in advance, embedded into your systems, your automations, your monthly review before the money arrives. Because the money arrives and the world immediately comes for it. The bills, the lifestyle creep, the emergency, the opportunity that costs more than you have. The money does not wait for you to be ready, it moves. The women who are financially stable are not the ones who earn the most. They are the ones who decided in advance, on a calm day, with a clear head, exactly what their money was going to do before it had a chance to disappear. They automated the savings. They funded the Roth IRA. They set the investment contribution, and then they lived on what was left. Decide what your money does before it arrives, because after it arrives, everyone else has already decided for you. Financially stable is not a destination, it is a practice. 13 laws, all of them simple, none of them requiring a finance degree, a large income, or a perfect starting point. What they require is a decision made today in this moment that your financial life is going to run on a different set of rules than the ones you inherited. Spend less than you earn. Pay yourself first. Keep one untouchable emergency fund growing quietly. Only carry debt the math supports. Buy one index fund and leave it alone. Never make financial decisions from fear. Let your savings rate grow with your income. Automate everything that does not need your judgment. Track your net worth, not your salary. Buy assets before aesthetics. Review monthly, not daily. Fill your tax advantaged accounts first and decide what your money does before it arrives. That is the whole system. Minimalist, repeatable, and compounding quietly into wealth every single month that you practice it. Here's your one action for this week. Pick the one law from this list that your financial life is currently breaking, the one that made you nod and look away a little. Open your bank account, your investment platform, or your notes app, and take one concrete step towards that law today. Not a plan, not a promise to yourself. One action this week. Share this with a woman in your life who is working hard but still feels financially stuck. Your friend who earns well but never seems to have anything saved. Your coworker who says she will start investing when things settle down. Your sister who is one unexpected bill away from a bad month. Things do not settle down first. We build stability first. And that starts today. I will see you in the next video.